If you took a stack of $100 bills and started piling them up, one by one, by the time you reached $1 million, your stack would be about 40 inches high, roughly the height of a kitchen chair. Manageable. If you kept going to $1 billion, that stack would reach into the sky, extending higher than the Burj Khalifa in Dubai. But we are not talking about billions today. If you stacked $36 trillion in $100 bills, that tower of cash wouldn't just scrape the sky. It would pierce the atmosphere, go past the satellites, and extend beyond the International Space Station. That is the physical scale of what the United States government owes right now. But numbers like this don't automatically mean collapse. They hide a much stranger reality. And if you turn on the news, that is exactly the movie they are playing. Every pundit, every economist, and every politician is screaming the same headline: the crisis is here, the collapse is imminent. They tell you that America is broke. They tell you that the dollar is about to become worthless paper. So, here's the question that should keep you awake at night, not out of fear, but out of curiosity. If the situation is truly this desperate, why hasn't the collapse happened yet? Why do the smartest investors in the world, billionaires, hedge funds, and sovereign wealth funds, continue to line up to buy this debt? Why do foreign nations, even those who aren't our best friends, keep holding trillions of dollars in US treasuries? If the US government is technically bankrupt by normal standards, why is the dollar still the most used currency on Earth? The answer is uncomfortable. To understand it, you have to be willing to unlearn almost everything you have been taught about being responsible with money. The truth isn't just about bankruptcy or solvency. It is about the hidden operating system of the global economy. Today, we are going to open up the machine and show you how it really works. The journey begins with the biggest lie in modern economics. It is a lie repeated at dinner tables and political rallies across the country. It goes like this: the government should run its budget just like a household runs its family budget. It sounds like common sense, right? It feels intuitive. When you sit down at your kitchen table to pay bills, you look at your income. If you earn $4,000 a month but you spend $5,000, you have a problem. You have to cut Netflix, stop eating out, sell your second car, or eventually you go broke. You declare bankruptcy, your credit score is ruined, and no one lends you money again. So, when people see the US government spending trillions more than it collects in taxes, they assume the same rules apply. They wait for the financial equivalent of a repo man to show up at the White House. But here is the fundamental difference that changes everything. You are a currency user. The United States government is a currency issuer. This distinction is not just a technicality. It is the whole game. As a household, or even as a business like Apple or Tesla, you have to earn dollars before you can spend them. You have to acquire money from someone else. The US government, however, is the source of the dollar. They don't have to find money to pay a bill. Now, this doesn't mean they can do whatever they want. We will get to the consequences later, but it means the risk of running out of money doesn't exist for them in the same way it exists for you. A household goes bankrupt when it cannot find the money to pay its debts. A government that borrows in its own currency can always create the money to pay the debt. The question isn't can they pay? The question is, what is that money worth after they pay? This brings us to the mechanics. How does this borrowing actually happen? Does the president just call the bank? Think of national debt not as a bill that needs to be paid off by next Friday. Think of it as a tool, a piece of financial engineering. When the government spends more than it taxes, it covers the difference by issuing Treasury bonds. A Treasury bond is essentially a fancy IOU. It's a piece of paper that says, if you give me $1,000 today, I promise to give you back your $1,000 plus interest in 10 years. Why would anyone buy that? Because it is considered the risk-free asset. In the chaotic world of finance, where stocks can crash 20% in a day and crypto can vanish overnight, a US Treasury bond is the bedrock. It is the safest place to park cash. This allows the government to build interstate highways, fund the most powerful military in history, and keep the economy from freezing during massive shocks like the 2008 financial crisis or the global lockdowns of 2020 without waiting decades to save up the cash in a piggy bank. If the government stopped borrowing completely tomorrow, the results would be catastrophic. To balance the budget overnight, they would either have to tax every American citizen at rates nearing 80–90%, or They would have to shut down the military, stop all social security checks, and let bridges crumble. Debt is the lever that allows the state to function smoothly over time. But wait, you might ask the obvious question. If the government can just create money, why do they need to borrow it? Why not just print unlimited cash and pay for everything? That is the most dangerous temptation of all. And the answer is one word: inflation. Money is not wealth. Money is a claim on wealth. Wealth is the actual stuff: the food, the houses, the cars, the services. If you print 10 trillion new dollars tomorrow, but you don't produce any new houses or cars, you just have more paper chasing the same amount of goods. Prices skyrocket. We have seen this movie before. We saw it in Weimar, Germany in the 1920 seconds, where people brought wheelbarrows of cash to buy a loaf of bread. We saw it in Zimbabwe in the 2000s, where they printed trillion-dollar notes that were worth less than toilet paper. We are seeing it in Venezuela. Borrowing is different from pure printing. When the government borrows, it is taking existing money out of the economy from investors and putting it back in through spending. It's a recycling loop. But more importantly, by issuing bonds that pay interest, the government is forcing a discipline on itself. They are promising future productivity. Ideally, the money borrowed today creates enough economic growth, new businesses, better jobs that the future tax revenue is high enough to pay back the interest easily. It is leverage, intended to make the country richer, not poorer. Now, let's address the elephant in the room: the geopolitical fear. The news headlines love to show images of the Chinese flag or the Japanese flag looming over the US Capitol. The narrative is simple: China owns us. If they call in the debt, America collapses. This is a powerful story. It creates fear. But it is a myth. Let's look at the actual data, the ledger of who owns these $36 trillion. You might be surprised to learn that the single largest holder of US debt is not China. It's not Japan. It's not Saudi Arabia. The biggest holder of US debt is you. When we break down the ownership, the vast majority, over 70%, is owned by domestic entities. Who are they? US investors and institutions. These are your private pension funds, insurance companies, and mutual funds. If you have a 401(k) or a retirement plan, look at the portfolio. You will likely see government bonds. You are lending money to the government to ensure you have a retirement. The Federal Reserve. The US central bank buys government debt to control interest rates and manage the money supply. The government itself. This is the strangest part. Agencies like the Social Security Trust Fund collect more in taxes than they pay out in benefits, historically. They don't put that cash under a mattress. They buy US Treasury bonds to earn interest. So, when politicians talk about defaulting on the debt, they aren't just talking about stiffing a foreign adversary. They are talking about wiping out the savings of American grandmothers, crashing the US insurance market, and bankrupting the Social Security system. It is a form of financial suicide. Now, what about the foreign countries? Yes, Japan and China own trillions, but they don't buy this debt to control America. They buy it because of trade surpluses. Think about it. China sells the US billions of dollars worth of electronics, clothes, and toys. In return, they get paid in US dollars. Now, China has a mountain of dollars. What can they do with them? They can't spend them in China. They need yuan for that. They can't just keep billions in cash sitting in a vault. Inflation would eat it away. So, they need to invest it somewhere safe, liquid, and stable. The US Treasury market is the only pool big enough to hold that much water. They are lending to us because they sold to us. It is a symbiotic relationship, not a master-servant one. But what happens when this delicate dance goes wrong? What happens when a country borrows too much, but unlike the US, they cannot print the currency they borrowed in? This brings us to the global safety net and the confusion surrounding the IMF and the World Bank. To fix your mental map, we need to separate these two giants. Think of the World Bank as a global architect. Their job is long-term development. They look at a developing nation, say, in Africa or Southeast Asia, that needs a dam for electricity or a highway system for trade. The World Bank says, here is a low-interest loan to build this project that will take 20 years to pay off. They are there to build the foundation of an economy. The IMF, International Monetary Fund, is completely different. They are the emergency room doctor. You don't go to the IMF when you are healthy. You go there when you are bleeding out. When a country like Argentina, Greece, or Pakistan runs out of money and no private investor will lend to them because the risk is too high, the economy starts to collapse. The currency crashes. Imports of medicine and fuel stop. In this chaos, the IMF steps in as the lender of last resort. They will give the country a loan to stabilize the currency and keep the lights on. But, and this is a big but, it comes with conditions. This is known as conditionality or austerity. The IMF acts like a strict financial dietitian. They say, we will save you, but you must cut government spending. You must raise taxes. You must sell off state-owned companies. These measures often lead to massive protests and social unrest because they are painful for the average citizen. But the logic is that, without this bitter medicine, the patient risks total systemic collapse. The US, however, has never needed the IMF. Why? Because the world never stops lending to the US. So, does this mean the United States is invincible? Does it mean debt doesn't matter and we can borrow $100 trillion with no consequences? Absolutely not. The laws of gravity still apply, even to a superpower. While the US might not run out of money, solvency risk, it faces a much more insidious threat. It is a slow-motion crisis that we are watching unfold in real time right now. It is called the interest trap. Remember, every bond pays interest. As the pile of debt grows from 10 trillion to 20 trillion to 36 trillion, the interest bill grows with it. But recently, something changed. Interest rates went up. Suddenly, the cost of servicing that debt exploded. We are now seeing a terrifying milestone in the US federal budget. The government is spending more on interest payments to bondholders than it spends on the entire national defense budget. Let that sink in. The US military, with its 11 aircraft carriers, thousands of jets, and bases all over the world costs roughly $850 billion to $900 billion a year. The interest on the debt is now crossing $1 trillion a year. This creates a phenomenon known as crowding out. Every dollar that goes to pay interest is a dollar that cannot be spent on education. It cannot be spent on cancer research. It cannot be spent on infrastructure. And it cannot be returned to you in the form of tax cuts. The money enters a black hole. It is transferred from taxpayers to bondholders, adding zero value to the current economy. This leads to a vicious cycle, a death spiral. To pay the interest, the government has to borrow more. This adds to the debt pile, which increases the interest bill next year, which requires even more borrowing. If this cycle continues unchecked, eventually the interest eats up the entire budget. The government becomes a zombie existing solely to pay its past creditors, unable to fund its future. This causes inflation to rise, growth to slow, and the standard of living to decline. You don't wake up one day and find the country destroyed. You wake up every year and realize your grocery bill is higher, your taxes are higher, and the roads are a little worse. That is the real price of debt. So why hasn't this death spiral killed the US yet? Why did Sri Lanka collapse with much less debt while America keeps going? This is the final piece of the puzzle, the secret weapon. It is what the French finance minister in the 1960 seconds called America's exorbitant privilege. The US dollar is the world reserve currency. In the global economy, if Brazil wants to buy oil from Saudi Arabia, they don't pay in Brazilian reals. Saudi Arabia won't accept them. They don't pay in Saudi reals. They pay in US dollars. Oil, gold, copper, wheat, almost all major commodities on Earth are priced and traded in dollars. This means that every country on Earth needs dollars just to survive and trade. There is a constant, insatiable global demand for US currency. This demand acts like a giant cushion. It allows the US government to borrow cheaper and deeper than any other nation in history. We can export our inflation to the rest of the world. We can print money, and the world absorbs it because they need it. This privilege is the only reason the $36 trillion tower hasn't fallen over. But it relies on one thing: trust. The world trusts that the dollar will remain stable and useful. If that trust breaks, if the world decides to start trading oil in yuan, or gold, or Bitcoin, then the demand for dollars evaporates. The trillions of dollars held overseas would flood back into the US, causing hyperinflation that would make 2022 look like a joke. That is the extreme scenario. It's not a default, it's a currency rejection. So before you close this video and feel either terrified or weirdly relieved, I want to slow things down for just a moment. Understanding national debt isn't supposed to make you panic, and it's not supposed to make you feel enlightened either. Its real purpose is simpler than that. It's meant to give you orientation. Most people feel anxious about debt because they're staring at a giant number with no map. 36 trillion sounds apocalyptic when you don't know how the system underneath actually works. Once you understand the mechanics, the fear doesn't disappear, but it changes shape. It becomes something you can reason about. So here's what this video is not saying. It's not saying the United States is about to collapse tomorrow. It's not saying debt doesn't matter. And it's definitely not saying there's some secret villain pulling all the strings. What it is saying is this: debt is a tool, a powerful one. And like any powerful tool, it works until it doesn't. The real danger isn't a sudden default. The real danger is slow erosion, when interest payments quietly crowd out the things that actually improve daily life: education, infrastructure, healthcare. You don't get a dramatic collapse. You get a gradual decline that's hard to notice until years have passed. So if you're looking for a signal to watch, don't fixate on the debt clock. Watch the interest bill. Watch how much of the government's budget is going toward the past instead of the future. And on a personal level, here's the most important takeaway. Understanding this system doesn't mean you need to fear it. It means you're less likely to be manipulated by headlines, panic, or oversimplified narratives. When you have a mental model, confusion turns into curiosity. And curiosity is always safer than fear. In the next video, we're going to take this one step further. We'll look at what happens if the world starts moving away from the dollar, and what that would actually mean in real, practical terms. Not theory, not hype, reality. If you want to understand the system instead of being overwhelmed by it, make sure you're subscribed, because the goal here isn't to scare you. It's to help you see the machine clearly.